600 million ounces. That's how much silver JPMorgan Chase has accumulated since 2011, the largest private silver hoard in American history. Bigger than most countries, bigger than the Hunt brothers ever dreamed of. And they did it quietly, methodically, while telling their clients silver was a bad investment. Now, their own analysts are saying silver could hit $150. That's a fivefold increase from today's price. JPMorgan doesn't make predictions like this. They're the biggest bank in America. They don't hype, they don't speculate, they position. And right now, they're positioned for something massive. Something is coming. Something big enough that the most powerful bank on Wall Street spent 13 years building the largest silver stockpile in modern history. And understanding what's happening right now means understanding patterns that have repeated throughout financial history. By the end of this video, you'll know exactly what JPMorgan has been doing. You'll understand why they accumulated 600 million ounces while suppressing the price. You'll see the three catalysts converging right now that their analysts believe could send silver past $150. And you'll understand the historical context of what this pattern has meant in the past. Because here's what the data shows. This isn't just about one metal's price movement. This is about structural changes in currency systems, supply chains, and industrial demand that are colliding simultaneously. Let me show you what the biggest bank in America has been doing in plain sight. 2011. Silver hits $49 per ounce. Retail investors flood the market. Everyone's buying. The media calls it a bubble. JPMorgan does something unexpected. While silver was spiking, JPMorgan was shorting, selling paper silver they didn't own, driving the price down. The Commodity Futures Trading Commission investigated them, fined them nearly $1 billion for manipulating precious metals markets, the largest penalty in CFTC history. This is documented fact, not speculation. But here's what the investigation revealed. While they were shorting paper silver and pushing prices down, they were simultaneously accumulating physical silver, massive quantities. They were using their own price suppression to accumulate metal at lower prices. Pay $1 billion in fines. Accumulate 600 million ounces worth tens of billions. Consider that strategy from a purely analytical perspective. If you believe an asset is undervalued and you want to accumulate a massive position, buying openly would spike the price. You'd be purchasing at higher and higher levels. You'd alert the entire market to your intentions. Instead, they shorted the paper market, sold futures contracts. Price dropped. Then they accumulated physical metal at depressed prices. They eventually got fined. They paid it, because now they control 600 million ounces that they acquired at prices ranging from $15 to $20 per ounce on average. And they're holding it. The question every market analyst is asking, what are they waiting for? The most logical answer based on historical patterns, they're waiting for the moment when paper silver and physical silver decouple completely. When the price suppression mechanism falls apart, when industrial users and investors simultaneously realize there isn't enough physical metal to meet demand. When spot silver moves vertically. Whether that moment comes or not, JPMorgan is positioned for it. Right now, three separate forces are converging. Market analysts are tracking all three. Understanding them helps explain why JPMorgan's analysts are projecting such dramatic price increases. The American economy is electrifying. Cars, homes, infrastructure. This transition requires silver in quantities that dwarf historical usage. Electric vehicles use 2 to 3 times more silver than gasoline vehicles. Ford's F-150 Lightning, Chevy Silverado EV, Tesla Cybertruck, Ram 1500 REV. Every electric vehicle requires nearly a kilogram of silver for electric motors, battery management systems, and onboard electronics. The infrastructure bill allocated hundreds of billions for EV charging stations across America. Each station requires silver for wiring, inverters, and electrical connections. Multiply that by projected station counts, and you're looking at millions of additional ounces of annual demand. Solar represents even larger demand. One solar panel uses up to 20 grams of silver. The average residential installation requires 25 to 30 panels. That's 500 to 600 grams per installation. Tax incentives for residential solar mean millions of American homes are adding these systems. 5G infrastructure build-out continues across America. Every 5G tower uses silver. Every smartphone contains silver. Modern iPhones contain over half a gram each. With 300 million American smartphone users upgrading regularly, the demand compounds. Defense spending adds another layer. America's military uses silver extensively. Missiles, radar systems, electronic warfare equipment, drones, fighter jets. The F-35 program alone uses over 400 grams of silver per aircraft, with hundreds being manufactured. The Silver Institute projects industrial demand will reach 700 million ounces in 2025. That represents 60% of total supply. And projections show this number increasing annually as electrification expands. The challenge: global mining isn't keeping pace with this demand growth. American silver production peaked in 2014. Output has declined consistently since then. Primary silver mines are depleting. Secondary production from lead, zinc, and copper mining is declining as these base metals become harder to extract profitably. Mexico supplies 23% of global silver. Their production has plateaued. Peru supplies 18%, also flat. China produces silver but has restricted exports, keeping metal for domestic use. Russia produces silver but faces sanctions that limit metal flow to Western markets. Recycling cannot fill the supply gap. Only approximately 15% of silver gets recycled because it's dispersed in tiny amounts across millions of products. Gold jewelry can be melted down economically. Silver embedded in smartphone circuit boards or solar panels cannot be extracted profitably. The result is a structural deficit. Global silver consumption exceeds production. The deficit reached 148.9 million ounces in 2024, marking the fourth consecutive year of deficit conditions. This means above-ground stockpiles are being drawn down. COMEX registered silver vaults dropped from 80 million ounces to 43 million ounces over 8 weeks recently. This is the silver available for delivery against futures contracts. It was reduced by nearly half in 2 months. London vaults show similar drawdowns. Shanghai vaults show similar patterns. The U.S. Mint has rationed Silver Eagle production in both 2023 and 2024, citing raw material sourcing challenges. When supply declines while demand increases, historical market patterns show price increases. Whether those patterns hold this time remains to be seen. But JPMorgan appears to be positioning for that outcome. This represents the macro backdrop that analysts believe is driving JPMorgan's positioning. America's national debt crossed $36 trillion. The rate of increase is accelerating, adding approximately another trillion every 100 days. The annual interest on that debt now exceeds $1 trillion, just the interest payment. This exceeds defense spending. Tax revenue cannot cover these interest payments. The mathematical reality is that new currency must be created to service existing debt. The Federal Reserve creates this currency. The government spends it. The debt grows. The cycle continues. Each dollar created dilutes the purchasing power of existing dollars. This is the mechanism of monetary inflation, distinct from the Consumer Price Index calculations that track consumer goods prices. Historical data shows the dollar has lost 98% of its purchasing power since 1971, when the gold standard was abandoned and the currency became pure fiat, backed by government credit rather than physical assets. International monetary dynamics are shifting. BRICS nations are developing alternative payment systems. China and Russia increasingly settle bilateral trade in yuan and rubles. Saudi Arabia has begun accepting yuan for oil transactions in specific deals. The petrodollar system that has supported dollar dominance for 5 decades is showing structural changes. Central banks globally are purchasing gold at record rates, documented by World Gold Council data. They are diversifying reserve assets away from dollar concentration. When central banks shift to accumulating physical precious metals, market analysts view this as significant signaling. Silver's relationship to gold is relevant here. The gold-to-silver price ratio currently sits around 88 to 1. Historical averages over centuries show approximately 60 to 1. If this ratio reverts toward historical norms, with gold at current prices around $2,700, mathematical calculation suggests silver would need to trade near $45. This would represent reversion without any crisis scenario, simply statistical normalization. However, if currency stress accelerates, historical patterns from previous fiat currency crises show precious metals, particularly silver, moving far beyond statistical averages. Silver serves dual roles as both monetary metal and critical industrial material for technology infrastructure. JPMorgan's positioning suggests they have analyzed these dynamics. Their 600 million ounce accumulation, built over 13 years, represents preparation for scenarios where these three catalysts converge. Understanding silver markets requires understanding the distinction between paper and physical markets. The price quoted in financial news represents the paper market, futures contracts, derivatives, and financial instruments that represent claims on silver. The COMEX silver market trades billions of dollars in contracts daily. However, only 43 million ounces of registered physical silver back those contracts. That's approximately $1.5 billion in actual metal, supporting a market with hundreds of billions in notional open interest. This represents fractional reserve mechanics applied to commodities. For each ounce of physical silver in vaults, there exist 50 to 100 paper claims on that ounce. This structure functions smoothly when most traders close contracts for cash rather than demanding physical delivery. The question analysts are examining: what happens when physical delivery demand increases? What happens when industrial users require actual metal for production? What happens when investors demand physical rather than financial instruments? Current data shows vaults are draining. Physical demand is exceeding paper market expectations. Whether this leads to market structure changes remains uncertain, but it represents a development worth monitoring. Historical precedent exists. The nickel market in March 2022 experienced disruption. Russia's invasion of Ukraine caused nickel prices to spike dramatically. The London Metal Exchange halted trading, then canceled and reversed executed trades, citing inability to ensure physical delivery. Billions of dollars in completed transactions were simply voided. If this occurred in nickel, the possibility exists in other commodity markets. Whether it occurs in silver depends on how supply-demand dynamics develop. JPMorgan holds 600 million ounces of physical metal in their own vaults, under their direct control. This represents preparation for scenarios where paper and physical markets diverge. Financial institutions don't accumulate assets without analytical justification. They build positions based on projected outcomes. JPMorgan's silver position is larger than their gold position relative to market size, which tells analysts something about their internal modeling. Their risk models are projecting specific scenarios. These likely include elevated inflation, potential dollar devaluation, and supply crisis possibilities. Their position reflects preparation for these outcomes. The risk-reward calculation from their perspective: if silver remains stable at $30, they hold 600 million ounces worth approximately $18 billion. Storage costs are negligible relative to asset value. If silver reaches $150, as their analysts project, that position becomes worth $90 billion. If prices exceed that, returns scale accordingly. This isn't speculation on their part in the traditional sense. This is institutional positioning based on quantitative analysis of supply-demand fundamentals and macroeconomic conditions. The timing question remains uncertain. When does potential decoupling between paper and physical occur? When does price discovery shift from futures markets to physical dealers? These questions don't have definitive answers, But JP Morgan's actions suggest they believe the probability is significant enough to justify a 13-year accumulation program and $1 billion in regulatory fines as cost of entry. Understanding current developments requires historical context. This isn't about predicting the future. This is about recognizing patterns that have repeated through monetary history. Rome progressively debased their silver denarius over centuries. They reduced silver content while maintaining face value. Eventually, the currency system collapsed. Those holding actual silver maintained purchasing power through the transition. John Law's Mississippi Scheme in 1720. France involved paper money backed by colonial land speculation. The scheme collapsed. The paper currency became worthless. Those holding gold and silver preserved wealth through the crisis. Revolutionary War continental currency depreciated so severely that "not worth a continental" became common expression meaning worthless. Hard money maintained value. Confederate dollars were backed by government credit during the American Civil War. They lost the war. The currency went to zero. Silver coins retained value. Weimar Germany in 1923 provides the most dramatic modern example. Money printing to pay war reparations led to hyperinflation. Trillion-mark notes were issued. Wheelbarrows of cash were needed for basic purchases. Those holding gold and silver maintained purchasing power through the crisis. Statistical analysis shows every fiat currency in recorded history has eventually failed. The average lifespan is approximately 27 years. The US dollar has operated as pure fiat currency since 1971, when the gold standard was abandoned. That's 54 years, well above the historical average. This doesn't mean collapse is imminent. It means the current system has operated longer than historical averages without hard asset backing. How much longer it continues is unknown. But the pattern is documented across centuries and civilizations. Analyzing JP Morgan's actions reveals a clear strategy. They identified a future scenario. They positioned for it. They used market manipulation, for which they were fined, to improve their entry price. They paid regulatory penalties as operational cost. They accumulated the asset. Now they wait. The timeline was extensive. 13 years of accumulation. This wasn't a quick trade. This was strategic positioning for long-term structural change. Their accumulation occurred during a period when silver was relatively unloved by markets and trading at depressed prices. They built the position when it was cheap, when competition for physical metal was limited, when supply was still accessible. Now, supply is tightening. Industrial demand is accelerating. Currency system stress is mounting. The catalysts they likely identified 13 years ago are activating. Whether their analysis proves correct depends on how these dynamics develop. But understanding their positioning provides insight into how the most sophisticated financial institution in America views precious metals markets and monetary system risks. Several developments are worth monitoring for anyone studying these markets. Vault inventories are declining across major storage facilities. COMEX, London, Shanghai all show drawdowns. This indicates physical metal is leaving vaults, suggesting demand for actual possession rather than paper claims. Premiums over spot price have been increasing. When buyers pay $3 to $5 above spot price for retail coins, that's normal market structure. When premiums widen to 10, 15, or higher, it signals supply tightness relative to demand. Backwardation has appeared intermittently in silver markets. This means spot prices trade above futures prices. Normally, futures should trade at premium to spot because of storage costs and time value. When this inverts, it suggests immediate physical demand is overwhelming future supply expectations. Mint production constraints continue. The U.S. Mint has been unable to meet demand for silver eagles, implementing rationing. When government mints cannot source enough raw material to meet coin demand, it signals something about underlying supply conditions. South Korean banks suspended silver sales in February 2025. 4 major institutions simultaneously stopped offering silver products, not temporarily, indefinitely. These are large banks with global connections. If they cannot source silver, it reveals something about actual market availability. China has restricted precious metals purchases through banking channels and raised risk classifications. They've also restricted exports and now require physical deposits for futures trading. These are significant policy changes by the world's largest industrial economy. These signals don't predict future prices. They describe current market conditions. How these conditions develop determines whether JPMorgan's positioning proves prescient or premature. Market analysts tracking these developments are monitoring several key indicators. The gold-to-silver ratio remains at historically elevated levels. Whether it reverts to long-term averages matters for relative pricing between the metals. Industrial demand growth versus mining supply trends will determine whether deficits continue or resolve. Current trajectories suggest deficits persisting, but technology changes or new discoveries could alter this. Currency system stability represents the macro backdrop. Federal Reserve policy, government debt trajectory, international monetary system evolution all factor into precious metals demand dynamics. Paper market structure integrity is being tested. Whether COMEX and other exchanges can continue functioning smoothly as physical demand increases remains to be seen. Historical precedent shows commodity exchanges have halted trading or changed rules when stressed. Central bank accumulation patterns provide insight into institutional thinking about reserve asset allocation and currency system confidence. These factors will determine whether JPMorgan's $150 projection materializes, falls short, or gets exceeded. Most observers will not act on this information, even if they understand it. This is human nature. Taking action requires overcoming inertia. It requires acknowledging system fragility. It requires making decisions and changing behavior. It's psychologically easier to hope everything works out. It's more comfortable to believe that complex problems will be solved by competent authorities. It's simpler to assume this time is different. That's a legitimate choice. Maybe the system adapts. Maybe new supply sources emerge. Maybe demand plateaus. Maybe currency concerns prove overblown. History provides examples of systems that bent but didn't break. But understanding what JPMorgan is doing with 600 million ounces provides information about how the most sophisticated financial institution in America views probability distributions of future outcomes. They're not positioning for stability. They're positioning for disruption. Whether that disruption comes, when it might come, and how severe it might be, nobody knows with certainty. But their actions reveal what they consider possible enough to justify a position of this magnitude. The most honest statement about timing is that nobody knows. JPMorgan has been accumulating for 13 years. They might hold for another 13. Or events could accelerate rapidly. Currency crises, when they occur, tend to happen gradually, then suddenly. Confidence erodes slowly, then breaks quickly. Tipping points are obvious in hindsight, but difficult to predict in advance. Industrial demand changes are more predictable. Electrification trends are clear. Solar adoption continues. EV production is scaling. 5G build-out progresses. These create steady, compounding demand increases. Supply constraints develop over years. Mines deplete gradually. New discoveries are rare. This is a slow-moving variable. The wild card is monetary system stress. Government policy decisions, international monetary system changes, confidence shifts in reserve currencies. These can change rapidly or persist for decades. JPMorgan is positioned for multiple time frames. Their holding period can be flexible because they control the asset. They're not forced sellers. They can wait for their scenarios to develop. The scale of JPMorgan's position matters. 600 million ounces represents roughly 20% of annual global silver production. It's equivalent to multiple years of production from a major mining country. It's larger than many nations' strategic reserves. An institution doesn't accumulate a position of this magnitude on speculation. This represents conviction based on analytical work by teams of quantitative analysts, economists, and strategists. Their $150 price target, if achieved, represents a wealth transfer of over $70 billion just on their position. From where does that wealth transfer? From holders of depreciating assets to holders of appreciating assets. From paper to physical. From claims to tangible goods. This is the nature of monetary transitions throughout history. Wealth doesn't disappear, it transfers. Those positioned correctly on the right side of the transfer build generational wealth. Those on the wrong side watch purchasing power evaporate. JPMorgan has chosen their side. They've spent 13 years and billions of dollars positioning. They've paid regulatory fines. They've built infrastructure to store physical metal. They've committed resources at institutional scale. Understanding what they're doing doesn't require agreement with their analysis. It simply requires recognizing that they're doing something significant based on their view of future developments. Here's where the analysis leads. Industrial demand is accelerating. Supply is constrained. Currency system stress is mounting. Paper market structure is being tested. The biggest bank in America has accumulated 600 million ounces, and their analysts project $150. The pattern is documented. The catalysts are active. The timeline is uncertain, but the setup is clear. Everyone must now make their own assessment. Does this analysis make sense? Are the patterns real? Are the catalysts significant? Is JPMorgan seeing something others miss? These aren't questions anyone else can answer for you. Financial decisions are personal. Risk tolerance varies. Situations differ. Resources vary. But understanding what's happening provides better information for making those personal decisions. Ignorance doesn't protect anyone. Knowledge at least provides options. JPMorgan made their decision 13 years ago. They've committed fully to their analysis. Whether they're right will become clear over time. But they've shown their position. They've revealed their thinking through their actions. The window for observing these developments is open. How long it stays open, nobody knows. What happens next depends on how these three catalysts develop. Whether industrial demand continues growing, whether supply constraints persist, whether currency stress intensifies. These are the variables worth monitoring. These are the factors that will determine whether JPMorgan's analysts prove correct about $150 silver or whether something else happens entirely. JPMorgan's analysts project $150 silver. That's their institutional forecast, 5 times current prices. Whether that target is reached depends on how the dynamics described here develop. But $150 assumes relatively orderly markets. It assumes paper and physical markets remain connected. It assumes the monetary system experiences stress but not collapse. These assumptions might hold, they might not. Nobody can predict the future with certainty, but patterns provide probabilities. History provides context. Current data provides signals about trajectory. JPMorgan has positioned for a range of outcomes. Their worst case is owning 600 million ounces of an essential industrial metal with limited supply. Their best case is capturing extraordinary returns during a major monetary system transition. They're comfortable with that range. They've committed institutional capital based on that assessment. Understanding their positioning doesn't require taking identical action. It requires understanding that sophisticated institutional analysis has led to this conclusion. Whether that analysis is correct remains to be seen. But the analysis is serious. The commitment is real. The implications are significant. The pattern is clear. The catalysts are converging. The biggest bank in America has made their bet. The question is whether their analysis of what lies ahead proves accurate. Time will tell. Everything presented in this video is for educational and informational purposes only. This is analysis of market conditions, institutional positioning, and historical patterns. This is not financial advice. This is not investment advice. This is not a recommendation to buy, sell, or hold any asset. I am not a financial advisor. I am not qualified to provide investment recommendations. Every person's financial situation is unique. Risk tolerance varies. Investment goals differ. What makes sense for one person may be completely inappropriate for another. The analysis of JPMorgan's positioning is based on publicly available information, regulatory filings, and market data. The interpretation of that data represents one analytical perspective among many possible perspectives. Markets are unpredictable. Historical patterns do not guarantee future results. Institutional positioning can be wrong. Projections frequently miss their targets. Commodities markets are volatile and risky. Anyone making financial decisions should consult with qualified financial professionals who understand their specific situation, goals, risk tolerance, and complete financial picture. Do your own research, seek professional advice, make informed decisions based on your personal circumstances. This content is provided solely for educational purposes to help viewers understand market dynamics, institutional behavior, and historical context. It is not personalized advice for any individual situation. If this analysis provided useful context, if you learned something about market structure, if you understand institutional positioning better now, hit that subscribe button. Because understanding these patterns and market dynamics is an ongoing process. In upcoming videos, I'll continue analyzing market developments, institutional positioning, currency system dynamics, and historical patterns. The goal is education and understanding, not prediction or recommendation. Subscribe so you stay informed about market developments. Turn on notifications for new analysis, and leave a comment below sharing your perspective. What do you make of JPMorgan's positioning? Do you see these patterns? How do you interpret current market signals? This is a community of people interested in understanding market dynamics and institutional behavior. Your analytical perspective contributes to collective understanding. The purpose here is education, analysis, and understanding market forces. Subscribe, comment, keep learning, stay informed.